Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down what is a TFSA and how to invest in your TFSA to maximize your tax-free long-term growth. I'll go over the benefits of a TFSA, the contribution limits based on your age, the rules to follow, and at the end, I'll go over what kind of investments you should hold in your TFSA to maximize your tax efficiency. The TFSA stands for Tax-Free Savings Account, and it is one of the most important tax-sheltered accounts offered in Canada, along with the RRSP. Since the TFSA is tax-sheltered, this means that any Canadian income you earn in your TFSA will not be taxed. So your investments inside a TFSA will grow much faster than they would in a non-registered account. Whenever you gain income in Canada, the government takes a piece of this profit in the form of taxes. I went over the 3 ways to earn income and the basics of taxes in chapter 1 of my Canadian tax guide. So click the pop-up at the top right to check that video out first. The 3 main sources of taxable income in Canada are employment income through working a job, business income, and investment income. Using a tax-sheltered vehicle like the TFSA is the best way to maximize your investment income. Investment income includes interest, which you earn through a savings account, GICs, or bonds. Dividends you earn from stocks and ETFs. Distributions, which are very similar to dividends, but they are taxed differently. Distributions come from REITs and income trusts. And capital gains, which is the profit you earn whenever you sell a stock or an ETF at a higher price than you bought it for. Interest, dividends, and distributions continually earn you income, either every month or every quarter, whereas capital gains are a one-time source of income you make whenever you sell your asset. Whenever you earn income through these 4 sources, the Canadian government will take a piece of this through taxes. I'll go over how each of these sources of investment income are taxed in an upcoming video. But if you use a TFSA, all of these income sources will be tax-free if they come from Canadian investments. TFSA stands for Tax-Free Savings Account, but this name is misleading. Your TFSA does not have to be a savings account. You can put almost any form of investment in your TFSA. Your TFSA is a large umbrella where you can hold stocks, bonds, ETFs, mutual funds, GICs, REITs, and cash in a savings account. And as long as these assets remain inside the TFSA umbrella, you won't be paying any taxes on them. In fact, you should treat your tax-free savings account as a tax-free investing account. The TFSA is a gift offered by the Canadian government to encourage Canadians to invest in the long term. But unfortunately, most Canadians don't use their TFSA to its full potential, and they only use the TFSA as a fancy savings account. With a savings account, you give your money to a bank and they pay you a very small interest rate of around 2% every year. This 2% interest will not earn you any long-term wealth because this money is losing around 2% of its value every year due to inflation. So your money sitting in a savings account will essentially be breaking even. As I talked about in my past video on the 4 steps to become wealthy, a savings account is a great way to protect your money because you're guaranteed to make at least a very small profit. You can't lose money in a savings account. But to generate long-term wealth, using a savings account in your TFSA is a waste of your limited contribution room. A savings account will only earn you 2% income, and so you would barely be paying any taxes on this income anyway. The income you earn with investments, like stocks and ETFs, far surpass the income you earn on a savings account. And so the taxes you would be paying on these investments are also much higher. That's why if you hold these investments in a TFSA, you gain a much greater tax benefit than you would if you just held a savings account in your TFSA. Stick around to the end of this video where I'll share my strategy for what kind of investments to hold in your TFSA to maximize your tax-free growth. The TFSA is an extremely flexible program, but it still comes with a few rules to follow. There is a limited amount that you can contribute to your TFSA. If there wasn't, then everyone would just invest all of their money in their TFSA and never pay any taxes. This contribution limit does not depend on your income, as it does with the RRSP. It only depends on your age. As soon as you turn 18, you can start contributing to your TFSA, and you gain additional contribution room on January 1st of each new year. Currently, everyone gains $6,000 of TFSA contribution room each year, but this annual amount changes year after year. When the TFSA first started back in 2009, the annual contribution increase was $5,000 a year until 2012. Then it was increased to $5,500, and then it was $10,000 for 1 year in 2015. Currently, in 2019 and 2020, the TFSA contribution limit increase was $6,000, and so we'll most likely see the same increase of $6,000 in 2021. Unused contribution room gets carried forward in future years. So don't worry about losing this room if you can't fill up your TFSA this year. If you don't want to calculate your contribution room by hand, use my handy table to find out the maximum contribution room you have based on your age in the year 2020. If you were born in the year 1991 or earlier, meaning you will be 29 or older this year, then your total available TFSA contribution room is $69,500. That means that if you have never added money to your TFSA yet, you are allowed to put this full amount, $69,500, into your TFSA account in the year 2020. If you were born in 1996, meaning that you are turning 24 this year, your total TFSA contribution room is $44,000. If you were born in 2002, then you are turning 18 this year, and so you can only put $6,000 into your TFSA in 2020. All of these numbers in this table are the total contribution limit you have, assuming that you have never put any money into your TFSA. But what if you have? Let's say I was born in 1996, and so my total TFSA contribution limit is $44,000. But let's say that 2 years ago, I invested $10,000 into my TFSA account. Whenever I make a TFSA contribution, that money is taken away from my total available room. So in 2020, I only have $34,000 remaining in TFSA room. One of the great things about the TFSA is that I can withdraw my money at any time, and I won't pay any taxes or fees. This is very different from the RRSP. Even better, when I make a withdrawal of my TFSA, I don't lose that contribution room forever. In the next year, I will regain whatever dollar amount that I withdrew this year. Contributions in past years reduce my available room, but withdrawals in past year increase my current contribution room. Let's go back to my example where I had $44,000 of total contribution room, but in 2018, I put in $10,000, and so I only have $34,000 of available contribution room. Let's say that last year, in 2019, I withdrew $4,000 to pay for school. As soon as the new year hit, January 1st, 2020, my TFSA contribution room immediately increased by this $4,000 withdrawal amount. And so in 2020, my total available contribution room is higher at $38,000. Here's another way to look at it. My total available contribution room for 2020 equals my total lifetime contribution limit minus contributions I made in previous years plus withdrawals I made in previous years. So my available contribution room in 2020 will be $44,000 minus $10,000, my previous contributions, plus $4,000, my previous withdrawals, giving me $38,000. But this is a very important point. When I withdraw money from my TFSA, I don't regain that contribution room until next year. So let's say that in 2020, I have maxed out my TFSA room. I can't put any more money into my TFSA this year. But let's say that I need to withdraw $10,000 to help make a down payment. After I withdraw this money, my TFSA is still maxed out. I don't regain this $10,000 withdrawal until next year. Even though I took out $10,000 from my TFSA, I cannot put a single dollar into my TFSA for the remainder of 2020. I have to wait until January 1st, 2021. As soon as the new year hits, I regain that $10,000 of contribution room from my withdrawal, plus I gain an additional $6,000 of contribution room because it's a new year. So in 2021, I will be able to put $16,000 into my TFSA. And then I'll be maxed out again. Here's a tip. If you do have to withdraw money from your TFSA, try to do it at the end of the year in December. That way, you'll only have to wait 1 month until January to regain the contribution room that you withdrew. But if you withdraw from your TFSA in the beginning of the year in January, you'll have to wait a whole 12 months before you can put that money back into your TFSA. You can check your current available TFSA contribution room by logging on to your CRA account, but the amount listed on your account is not up to date. The CRA will only display your available TFSA contribution room up until December 31st of the previous year. And once the new year hits, it takes them over 2 months in March to calculate and confirm this amount. So don't rely on the amount that you see on your account. It is extremely important to keep track of every contribution and withdrawal you make from your TFSA. The government will only do this for you once a year during tax season. For the rest of the year, the responsibility is on you to make sure that you don't overcontribute. Because if you do, the penalties are severe. If you overcontribute to your TFSA, you will pay a penalty of 1% every single month on the excess amount above your available room. If I forgot to keep track of my TFSA contributions and I added $10,000 after I was already maxed out, I will be charged 1% of this $10,000, so $100 every single month until I withdraw this excess amount. If I'm not careful, this will cost me 12% a year. That's almost as bad as credit card debt. So make sure you make a record of every time you put money in or take money out of your TFSA. You are allowed to open up multiple TFSA accounts with different financial institutions. You can open up a TFSA savings account with Scotiabank to hold your cash, and at the same time, you can open up a TFSA investing account with QUESTRADE to hold your stocks and ETFs. There is no limit on the number of TFSA accounts you can have, but the total amount you've contributed to all of your TFSA accounts cannot exceed your TFSA contribution limit. Let's talk about the real power of the TFSA, investing. Any income you earn inside your TFSA is tax-free, so whenever you gain money through dividends, drips, interest, or capital gains, you keep all of it. Even better, any income you earn inside your TFSA does not count as a contribution. Every time you earn a dividend, this money was earned inside your TFSA, so it doesn't take away from your available contribution room. Your total value inside your TFSA can and should exceed your total contribution limit because your investments are growing. Let's go back to my example. If I'm 24 years old and I have maxed out my TFSA, that means I have contributed $44,000 into my TFSA. But if my investments grew to $100,000 in value, that's totally fine. I'm not breaking any rules. My only limit was the amount of money I could put in, the $44,000. But my investments grew by $66,000, and I don't pay any taxes on the $66,000 of income. If these same investments were outside of a TFSA, I would have to pay a huge chunk of these profits in taxes. But in a TFSA, I'm totally safe. There is no limit on how much money can be in your TFSA. There's just a limit on how much money you can initially put in. If I just held cash, my money would never grow. And so the maximum amount I would ever have in my TFSA is $44,000. But with the power of investing, I now have a TFSA over twice that size. And here's something really cool. If I decide to withdraw this $100,000 out of my TFSA, I would not pay any taxes on this money. And next year, on January 1st, this $100,000 withdrawal will be added to my available contribution room. Plus, I would gain an additional $6,000 of available room because it's a new year. So on January 1st, I can now put $106,000 into my TFSA. This is more than double what my total contribution limit should be. But be careful, this withdrawal room can also work against you. Let's say I put in $44,000 into my TFSA and I decided to invest it in risky penny stocks, and my stocks crashed. Over the course of a few months, my $44,000 investment is now only worth $10,000. If I decided to sell these stocks and withdraw this $10,000 out of my TFSA, I have now permanently lost contribution room. Next year, when January hits, I cannot put in $44,000 back into my TFSA. I can only put in the amount that I withdrew, which is $10,000, plus the standard $6,000 I get every new year. So now, my TFSA is maxed out with only $16,000 in it. I have permanently lost TFSA contribution room, and I will never get it back. My TFSA is always going to be smaller than other people my age. Sure, I can still invest outside of my TFSA, but I will always be paying taxes on the income, while my neighbors are enjoying tax-free growth inside their larger TFSAs. The moral of the story is do not invest in risky penny stocks inside your TFSA. I'm against penny stocks in general, but if you must, keep any risky investment in a non-registered account. Your TFSA should be reserved for secure and established blue chip stocks and ETFs. And if your stocks inside your TFSA are currently down, don't sell them. Wait for them to bounce back. As soon as you sell them, those losses have become realized, and now you've permanently lost that TFSA room. So now for the fun part, what kind of investments should you hold in your TFSA? Any type of investment will benefit from the tax shelter nature of a TFSA. But since your contribution room is limited, you want to reserve it for assets which will gain the most benefit. Do not use your TFSA as a savings account. You'll only be earning about 2% in interest income, so there wouldn't be very much taxes anyway to be saved. Also, I wouldn't keep growth stocks in your TFSA. A growth stock doesn't pay you dividends. You buy it with the hope that it will increase in value over time, and then you sell it for a profit. But until you sell that growth stock, you haven't made any money. So if you hold onto a growth stock for 20 years, you have zero income over those 20 years. And so you pay zero taxes over that time. Holding a growth stock in your TFSA is wasting the tax-free benefit because you're not paying any taxes anyway during those years. Once you do sell your growth stock, you have now made a profit, and you do have to pay taxes on this profit. This is called a capital gains tax. Capital gains are the most tax-efficient form of income, especially as you get up to the higher tax brackets. In fact, capital gains are taxed at only half the tax rate of your employment income. If you held a growth stock in your TFSA, sure, you would never pay any taxes on these capital gains when you sell. Whereas outside, in a non-registered account, you would have to pay some taxes on these capital gains when you sell your stock. But capital gains are taxed at a lower rate than all other investments, especially when you get to higher incomes. So if you have to pay taxes on something, you might as well pay taxes on capital gains, which have the lowest tax rate. And you won't be paying any of these taxes for years and years until you actually decide to sell that stock. I'll be making a whole video on how different forms of investments are taxed, so stay tuned for that. Okay, so what should you hold in your TFSA? Income producing dividend stocks and ETFs. Dividend stocks and ETFs will pay you regular income through dividends every month or every quarter. These dividends are considered taxable income, even if you use a DRIP to earn extra shares instead of cash. This continuous income will compound your investments, allowing them to grow exponentially. But if you slap on a 20% tax on every dividend you get, that will constantly slow you down. That's why if you hold high yield dividend stocks and ETFs in your TFSA, you will never pay taxes on these dividends. And this will allow you to maximize this exponential growth. Check out my past videos on my favorite Canadian dividend stocks and my favorite Canadian dividend ETFs. All of these are great options to invest in your TFSA to get tax-free passive income. This is very important. The TFSA will only protect your dividends from Canadian investments. If you hold US stocks and US ETFs, you will be charged a 15% US withholding tax on these dividends, even in a TFSA. The only way to avoid paying this US withholding tax on US dividends is to hold these US investments in an RRSP. By the US-Canada Tax Treaty, an RRSP will protect you from taxes on US dividends, but a TFSA will not. I'll be making a whole video on US withholding taxes and on the RRSP, but the bottom line is this. Only hold Canadian investments in your TFSA. Your US investments should be held in your RRSP. Finally, when choosing Canadian dividend stocks for your TFSA, I would place extra emphasis on REITs, real estate investment trusts. Outside of a TFSA, REITs are taxed more heavily than regular dividend stocks. Eligible Canadian dividends are taxed at a much lower tax rate than regular income, especially for those lower tax brackets. If I'm in the 40% tax bracket, I only pay about 25% taxes on eligible dividends because of the dividend tax credit, which the government created to encourage Canadians to invest. However, REITs don't pay eligible dividends. They pay distributions. Distributions are a combination of the rent and capital gains earned by these real estate properties. These distributions kind of act like dividends because they provide consistent passive income, but they are taxed differently. Distributions from REITs are not eligible for the dividend tax credit. So if I'm in the 40% tax bracket, I'm going to be paying almost 40% taxes on the income I earn from these REITs, compared to the 25% in taxes I pay on the income earned from dividend stocks. Because REITs are taxed more heavily than regular dividend stocks, it's better to hold REITs in your TFSA since they'll gain an even greater tax benefit. So there you have it. That's everything you need to know about the TFSA. The TFSA allows Canadians to avoid paying taxes on their investment income. There is a maximum amount you are able to contribute to your TFSA based on your age. This contribution limit increases every year. Every contribution you make reduces your available room, and every withdrawal you make increases your available room in the next year. Your TFSA should be reserved for high-yield Canadian dividend stocks and ETFs, especially REITs. Your growth stocks should be held outside of your TFSA, and your US investments should be held in your RRSP to avoid withholding taxes. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really helps me build this channel, and hit that bell icon to be notified of my new videos every week. And if you'd like to follow me on Instagram or Facebook at CanadianTShirt, click the link in the box below or click the links on my homepage. And be sure to tune into my next video where I'll be breaking down how to buy and sell US stocks on QUESTRADE. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.